You know, in the world of global energy, there's this massive, invisible problem. We're talking about something that traps over $100 billion at any given time. It's a huge drag on the whole system, and it happens every single day. So what if we could unlock all that capital? Let's take a look at a new financial engine designed to do exactly that, and see how it might just reshape how money moves in the world's most important industry.
Okay, so before we get to the solution, we first have to get our heads around the sheer scale of the problem, the inefficiency. And it all kicks off with a number that honestly seems kind of hard to believe, but it's right at the heart of every single major energy deal.
$30 million. That's how much economic horsepower gets frozen just to support one single, much smaller trade. It's a staggering figure, right? And it really begs the question.
So how on earth does that happen? Well, the answer isn't about the risk of the energy itself. It's actually in the old, clunky financial plumbing that the whole market is built on. It's a system built on layer after layer after layer of redundant protection.
Let's actually walk through how this duplication works, because it's pretty wild. First, you've got the $10 million commercial invoice. That's the real value of the trade, but that money is totally illiquid. So to secure it, a bank issues a $10 million letter of credit, which ties up another $10 million. Then on top of that, cash often gets put into escrow, freezing a third $10 million. And if that wasn't enough, companies also have to hold risk margins on their balance sheets, making even more capital unusable. You can see how it just piles up.
So here's the key thing to get. This isn't about adding risk or leverage or anything like that. It's just duplication. It's born from pure inefficiency. And the solution is to just move away from that broken model to a completely new one, what we're calling capital compression.
And this slide really just lays it all out, the before and after. On the left, you've got the old way. Tons of redundant collateral for every single trade, and that capital is frozen for like 30 to 90 days. But on the right, you've got the new model, a single shared pot of money where capital is instantly reused. We're talking about a fundamental shift from a slow, murky system to one that's fast, centralized, and totally transparent.
This quote from the source material it nails it. The old system isn't broken because people are doing bad things. It's broken by its very design. It relies on all these redundant promises and collateral sitting in different silos because it literally can't settle things instantly. And that time, that delay, is the real enemy of capital efficiency.
So how do you fix a problem this big? Well, the proposed solution is a new piece of financial infrastructure called USDE. And the goal here isn't just to patch the old system, it's to build an entirely new foundation for energy finance from the ground up.
Visually, this is the core idea. Instead of dozens of separate, disconnected little pots of money between every single trading partner, you create one central, shared pool of liquidity. Everything clears and settles instantly against this one trusted source. Think of it like a hub-and-spoke model, but for money.
And it works using this really clever two-tier system. At the very center, you have the USDE core token. This basically acts as a stable, digital dollar for the final settlement. And then, built on top of that, you have this whole ecosystem of e-tokens. Now, these are basically digital twins of real-world energy assets, like a barrel of oil or a megawatt of power. All of these different e-tokens can then be traded and settled instantly against that stable core.
So you're probably wondering, what's actually backing that core reserve? Well, it's designed for stability. As you can see, the vast majority is held in super liquid stuff like cash and U.S. Treasury bills. The rest is held in something called program notes. The easiest way to think about these is as short-term loans that are directly backed by the energy sales flowing through the system itself. So it adds this credit component that is native to the network.
Now, this whole design is really elegant, but there's one component, one piece of the puzzle that is absolutely 100% critical to making it all work. It's the key that unlocks the entire idea of capital compression. And that is the transformation of the energy assets themselves into something digitally native, something that's ready for instant settlement. Without this step, the whole system just goes right back to being the old, slow, inefficient model. And this table here makes it crystal clear why these e-tokens are the absolute linchpin. With them, you can instantly turn a future payment into cash, you drive capital efficiency through the roof, and the whole market gets deeper. Without them? Yeah, none of that is possible. The system loses its entire economic advantage.
And that's really the bottom line. The e-tokens are what perform the magic trick. They reclassify a slow-moving, illiquid invoice into a standardized digital asset that can be settled in a flash against that shared reserve. It is truly the key that unlocks everything else.
Okay, so let's zoom out.
We've gone through the problem, we've looked at the mechanics of the solution, but what's the real-world impact of a change this big? Why does this new kind of infrastructure actually matter on a global scale?
Well, first, there's speed. I mean, we go from a settlement process that can drag on for up to 3 months to one that happens instantly. That completely eliminates the time delay, which is the whole reason you need all that duplicated capital in the first place.
And that's speed. Well, it has a massive financial benefit. Remember that crazy $30 million number we saw for a single $10 million trade? With this system, that number drops by about 90%. That capital is compressed, it's freed up, it can be used for productive things like funding new energy projects or accelerating R&D, instead of just sitting uselessly in a bank account somewhere.
And remember, we're not talking about some niche problem here. This is an $8 trillion global market, totally fragmented across more than 200 different countries and their rules. All that inefficiency adds up to over $100 billion in trapped capital, which is basically a constant tax on the entire global economy.
So, you see, this is about way more than just a faster payment system. It's about building a modern, transparent, and radically more efficient financial foundation for the whole global energy economy. Which leaves us with a pretty big question to think about. What new possibilities open up when you suddenly unlock $100 billion for the industry that literally powers our entire world?